Welcome to A Few Minutes with Peter Grandich. I'm your host, Al O'Grady, and for the next few minutes, we'll be talking to Peter, getting his insights on the markets, commodities, business, politics, sports, and life in general. Peter Grandich is the editor of the Grandich Letter, which was first published back in 1984. He's been a market strategist, portfolio manager of 4 hedge funds, a mutual fund that bared his name, and is widely known for his accurate forecasts and no-hedge markets perspective. He appears regularly on television and radio and is widely quoted in leading financial publications. He's also the co-founder and managing member of Trinity Financial Sports and Entertainment Management Company, an insurance and estate planning firm specializing in servicing professional athletes and entertainers. Peter, as always, welcome back to the program.
Thank you for having me, as always, Hal. It really is a pleasure.
Good. Thank you very much, Peter. Peter, as we start the fourth quarter of 2012, and I don't know where the year's gone, I thought we'd take a look back at the markets, give yourself a self-assessment of your forecast, if you will, and also gaze into your crystal ball in terms of what you see going forward. So having said that, let's start with the U.S. stock market. While not a rip-roaring bull by any means, one constant underlying theme of your market assessment since the first of the year was that the market was likely to head higher, not lower, as many people, especially within the hard asset community, were calling for. You often said it would come as no surprise to see the market make a new marginal all-time high this year. So, do you still feel that way?
I think, relatively speaking, it's as much chance now than it was when it was several thousand points lower. I hate to use the word however or if or maybe, but with a little asterisk. I think the only thing that could knock it off its heels would be the impending conflict in the Middle East getting out of hand or something at that level that is just unforeseen. Outside of that, the Fed's action, the floodgates opening, allows the don't worry, be happy crowd that prowl Wall Street to see the cup super half full. And I just think stocks will work higher, even though fundamentals shouldn't suggest it, because corporations aren't going to make a lot of money in a stagnant economy. So, yes, and it could go into spring before that happens. But I think once we get past late winter, early spring, the reality of yet another failed quantitative easing and the realization that the silver bullet's been shot, the kitchen sink has been shown by the Fed, we'll finally get a real negative reaction in the financial markets and head lower and substantially lower from whatever point we are at that time.
Okay, so follow up to that. If the markets are going, at least in the short term, to continue to rise, any sort of a projection in terms of a point total on this one?
I like I said, I think the Dow's high is 14,000 and change. There's a 10% or so further rise in it. It's not something I would run out and begin an equity portfolio to be in it. It's certainly not something that I wanted to been aggressively long in. But I think if you go back and look, and you really look from the lows of March 2009, there was a constant cry of market avoided, be shorted, and particularly from the hard asset community where, I dwell day to day, and anyone that would have followed that particularly short would have really had their heads handed to them. So I've learned, and I've said this before, it's not so much how you make, it's how much you stop yourself from losing that separates the winners from losers over time.
So, and then one last follow-up, and you hit on a key point. If there's no fundamental reason for it to go up, why does it?
Well, fundamental in the sense of this, why I say that. People forget that the equity market is supposed to be, although it really isn't, a place where people get to buy part ownership of businesses, just as if you and I wanted to pick certain ones we liked in our neighborhood. And we go down there and somebody for some reason thinks it's time to give up their part ownership and you buy it from them and hope someday somebody comes along and pays a higher price for the part ownership you want. Normally that's what stock markets are. In the last 20 or 30 years, they've come a lot more than that. I think they've become one big casino. And a lot of fundamentals that mattered 20, 30 years ago don't play in as much as money and the trading, and this is so many powerful things, computers moving it, trading in, 1/10 of seconds and things of that nature. And to understand and appreciate that, when I entered the brokerage business in 1984, the number was somewhere between 85 and 90% of the volume, the then volume on the New York Stock Exchange, was individual investors. Now it's something like 90 to 95% institutional. The little guy, or us, I mean, that's what I think we are compared to the big people out there, really have no input or effect on the markets. It's the major institutions and big trading houses that do. So they don't look at the general fundamentals in the way that we normally do, you know, in the thought of, I'm part owner, I like McDonald's, I think they're going to sell more hamburgers, and one day shares should be worth more. I think that's gone to the wayside for the most part.
Okay, fair enough. Let's move on. Let's talk about U.S. bonds. I believe calling it the worst investment for the next decade pretty much sums up your thoughts. But is there a scenario that you'd like to see?
Yeah, ideally, first of all, take a step back a couple days ago, maybe last night, I don't remember exactly when, I was very surprised, but pleasantly surprised to see a well-known mainstream so-called don't worry, be happy guy who's not been that much of a don't worry, be happy crowd of late, Bill Gross of PIMCO, put out an article that literally I thought, you know, I could have written myself because it was so much of my own thinking, and that, you know, this really bad social, economic, and political times it's going to come to shores, and he talked about how, to some extent, America will look like the Greece problem in not too distant future, and where that would impact, but not right away, mostly would be in the bond market. And so, you know, I've said this before, and I'll shorten my response this time. There's just no way getting something 10-year paying, you know, 1.6 now. I know inflation's more than that, or it's going to be more than that. And at the end of the day, the bond is not a stock where I'm looking to trade it in between the time before it matures. Most people are going to try to hold it to the maturity. It's just a losing investment, and it'll be a badly losing investment. In fact, if you took my daughter and said, well, how could you get it back? Well, it will be the least of the worst investment, stocks or bonds, over the next 10 years. I clearly say stocks will be the least worst versus I think they both could be down, but bonds are going to lose a lot more money. So I just think it's a void, but the scenario that I would love to see, ideally, is that as things get weaker, there continues to be more money flow into the bonds, and the 10-year gets to a new yield low somewhere around 1.25. And I just think that I would find the bulk of my capital going into a short position, but not before that.
Okay, no follow-up needed there. Let's move on to the U.S. dollar. This was certainly an area that you were bang on as far as your forecasts are concerned. You began the year predicting a bear market rally that could see the U.S. dollar index rise to about 83, 84, but such a feat in your mind would merely be a dead cat bounce in what you've called the terminally ill dollar. The index did indeed get there and has since turned down. Okay, now what?
Well, there's a little bit of a meandering here now. You're right. I think, you know, I've said all along, even at the height when there were 96% bulls on the dollar in the commodities futures market, and everybody was predicting not everybody, but outside the hard asset community, everybody was predicting a new rally for the U.S. dollar. I've said all along that it is in a long-term secular bear market. It will eventually lose its world reserve currency status and will eventually make a new low on that dollar index below 70. I think from a technical standpoint, and as we move to the end of the year here, the bulk of the futures trading and currency trading, and particularly for businesses that are doing hedges and all worldwide, usually ends around November 15th. So unless something spectacular happens to the market, I don't think there's a big move in either side of the currency. When we get into 2013, and call this political if you want, but I really think an Obama win accelerates the move to the downside because, A, it will almost a certain that the current Fed chairman will be Fed chairman because Romney's on record that he will not renominate him, and that could cause a change in Fed policy. And so an Obama win would assure that everything would be status quo, which is really bad for the dollar. So I just think as we get into next year and as we get into 2014, we'll make new lows on the U.S. dollar index. But I also point out to people, while the U.S. dollar index is the common index that people look at to watch dollar movements, it's not a balanced index, whereupon the currencies that make it up, the euro has the single most effect, and we all know what's been happening to the euro. If you look at the Morgan Stanley trade-weighted dollar index, it has remained in a decline all this time. So the dollar only has one place to go, lower. It's one of the reasons people probably ad nauseum that know me for years say this, but it's one of the reasons why I converted my own U.S. dollars, bulk of my savings, into Canadian dollars and sit in a Canadian financial institution. Now, I know can I do your follow-up?
Absolutely, absolutely.
As a Canadian, what should I do? Blah, blah, blah. Go ahead, give me your follow-up.
Okay, as a Canadian, what should I do? Blah, blah, blah.
Well, and I get that question quite a bit because I would probably say our U.S. readers are equal to our number of Canadian readers, and we get that question all the time. Mr. Grandich, I read you say this, what should I do? Well, obviously you have to look the ways to hedge your currency. You would have to, look at things that allow you to benefit from a Canadian rising dollar and also from a declining U.S. dollar. I can't give, individual advice, but there are products and services out there, and people need to talk to a financial advisor. But what I do say, and I got this asked most recently in a conference, and that is, what's the difference between a Romney win and an Obama win for the markets and the economy? And this is probably a good time to insert it here, and that is, Romney win forestalls the inevitable. An Obama win brings it on that much faster. And why I say that is, in my writings have said this for quite a while now, is we're past the point of no return. There is no easy fix or quick fix or a solution that's going to be palatable to most, no matter what anybody gets in or says it does. There's going to be a substantial period of pain and anguish no matter what. The only thing is a Romney win will forestall it and maybe lessen it to some degree because there's still a few things they can do to lessen it, but the overall scenario is bad and it's poor. So for all the markets, financial markets in the U.S., I think the window stays open to maybe as far as next spring or summer, but after that, I think the rooster finally comes home to roost, and we really do have a problem at that point.
Two follow-up questions, Peter. It's not a matter of if, but a matter of when China becomes the number one economy in the world, overtaking the United States. That's an inevitability. Do you feel that the Chinese yuan, and I know I'm not saying it right, the Chinese currency will actually become the world currency for safe haven?
I don't know. There's a lot of different moving parts that will affect that. One, China is slowing down more than some of us might have thought, only because the world is slowing down so fast. China, I also think, it's not in China's best interest to see the United States fall on its face and become like Greece.
Oh, it needs the United States to buy its products. Absolutely.
Yes, absolutely. Yeah. That's a mistake some people see and all. But at the same time, I think they want to be able to have far more influence on what happens here. So, in a sense, it's, if you remember the original movie Wall Street, when Gecko's getting it and his stock's in trouble, and the other Solarans, calls his broker and say, let's hold him here. Let's kind of bring him down to the canvas softly, more softly than he would have otherwise come down. That's what I think America has in front of it from China. In terms of a new world reserve, there's just too many variables. There's too many things that can happen in the world, and normally these things don't look as easy. They don't end up being as easy as we thought. But one thing I think for certain is the U.S., as you said, the world's number one economic power is gone. And eventually I just can't see the number two, and eventually, maybe not in our future. Well, you're younger than me. Maybe in the next 30 years when India
exactly
surpasses the United States.
Yep.
I don't see the third strongest economic power seeing its currency be the world reserve currency. I just don't see that. So eventually something does replace it.
Sure. My second follow-up is this. I know we're heading into the season where you have tax loss selling as far as the stock market is concerned. Is that also possible as far as dollars and currency trading more from an institutional side? Is that possible to have any sort of tax loss selling pressure? You know what I mean?
Yeah, I know exactly what you mean, and I think I have the answers. The commodities market, there's so much frequent trading. I don't think there's a whole bunch of people sitting with a particular loss and suddenly have to move out of a particular currency. We did see a tremendous amount of longs not too long ago, but I think one of the reasons the dollar has fallen because those longs have been caught, and those that were short the euro and all that have paid the price. So I don't think there's an awful lot of. Now, in the general equity market, I don't think we're going to have a lot of tax loss selling because the general equity market has been up. But where it will be, and I know you're going to get to that question eventually, I'm sure it's on your list, about the junior resource market, that's where the fact that there may even be more because people that have general equity gains in other areas will say, hey, you know what, this is a good time. I'm tired of watching this penny stock, and let me just take my loss and offset so I don't have to pay Uncle Sam some of my gains there. So markets that were down a lot in the general that are equity related will probably see more tax loss selling than they normally do.
Yeah, and you're absolutely right. We will be getting into that in just a few minutes. Let's change our focus here to gold. I remember when gold was heading towards $1,500 an ounce. There seems to be a new bearish prediction every day when that was happening. You not only stood your ground saying that gold remained in the mother of all gold bull markets, but you actually put your money where your mouth is, and you offered to bet $2 million on your bullish beliefs. Now, gold has since rallied sharply, but in a business of what have you done for me lately, what do you see in gold's future?
I just think it's a market. I've been glad that it stayed under 1,800 here for a few weeks. It's consolidating in its most recent gains. We had another great update last Friday. I continue to believe that any and all surprises should be limited to the upside, meaning that other than the occasional hourly or sometimes last for a day or two shakeouts, the market's going to work higher. All the fundamentals for gold remain, and the spigot that was opened by the Fed and others around the world just are going to accelerate the cause. And so it's just working its way higher. You're right. I would just encourage people to go back and read and just punch in and Google search something like predictions of gold declining and see all the people that just said it was over, the party's ended, not just the perma bears that have been out there, but so many of the people that were once bullish. And the market, again, withstood the test of time. And it is the most amazing, I won't see another market like it. I'd love to live another 30 years, but who knows? But I've never seen in my life something go up so much for such a long period of time and still meet such a few amount of people that actually participated in it.
Right.
I mean, it's a phenomenon. You would expect, when the 90s, by the time we went from the late 80s to 1996 or 7, everybody you knew was making money in the stock market. Probably it's the same thing in Canada. People were talking about, I got the second home, and Johnny's got a new car. Because people, your cab driver, everybody. Here's a market that's gone up 10 straight years. And, outside of the community we work in, which is a very small speck of an industry, there really hasn't been anybody that's benefited financially from gold in North America. When you get outside North America and Europe and Asia, then you find a lot of people who've been, salting away and, putting gold away in droves. And so, I just think it still has so much higher to go.
Okay. What about other metals, silver, copper? Those two come to mind.
Silver is, really should be a base metal because there's a lot of it in the ground, but it gets to tag along as the kissing cousin to gold, and at times gets to shine above it. There's still a small group that believes there's an extremely short position in it, in the COMEX, and that's going to lead to a runaway price. I just think it's going to work its way higher with gold, and it sometimes actually outperform it. Base metals is a bit different story. Copper has continued to surprise here despite world slowdown everywhere. It's really hard to pinpoint any place that's having really anything substantial growth. It's still well above $3, and I think that's because there's not an abundance of oversupply of it, and the fact that as it's gotten about as slow as it can get, and people are betting on that eventually, with all this money creation, economies will rebound again. And then, there's other metals out there, specialty metals, but I don't spend too much time in them. And I still, like I said, I still believe the place to be is, gold and silver, the precious metals.
Yeah, I think you just answered my follow-up question. You don't really watch too keenly. I was going to mention about rare earth elements and also vanadium, too. And
those things have their place, but I don't follow them enough to qualify myself as an expert. But, the arguments for them are strong. Look, the world is increasing so much in population, and still, by and large, people's living class is going higher worldwide. well, they're all going to need a lot of the things that seem to be in somewhat short supply. So that's why the commodity bulls, I think, still have a much better argument than the commodity bears.
And as the world grows, and energy is certainly going to be a requirement, you've remained bullish on oil and bearish on natural gas for quite some time. I assume nothing has changed in your prognosis with those two?
Yeah, I still think oil, is going to get above 100 and stay there, and, it'll come the new norm over the next couple of years. I do think the worst is behind in natural gas, and now we come into a favorably seasonal period. I wouldn't run out and buy natural gas stocks or look for the price to double, but I think we've seen the worst for the natural gas price, and because its season is now upon us, it can have somewhat of a rally into the winter.
Okay. We were talking about the junior resource markets, so let's go back.
All right, I got to go now,
Al. I think this is one area where you might be stinking up the joint there, Peter, as far as the junior resource market is concerned. Now, in fairness to you, you often say that failure is the norm, and people should really limit their exposure as far as the junior resource sector is concerned. But, having said all that, what's your latest assessment with junior resources?
Well, I did prove failure is the norm more than once. It's an interesting thing. It's funny you say that, and I'd like to maybe digress for a few minutes. There's a couple other things related to that. You can go out there, you can tell people over and over again, hey, look, maybe 5, maybe 10%. It's gambling money. You got to be prepared to lose part of all your capital and all. And then you can call the stock market right and the U.S. dollar right and not get people short bonds and all these other things you spoke about, being right on gold and all. And the only thing I ever hear about from people is how wrong I was when junior resource stocks. So that's just the life of this, I guess, that I have to learn to live. But you're right. We know the worst is behind us. But again, a month or two ago, there were a lot of people then started writing to me, look, I think you're being too cautious. The worst is behind us. I agree with you. But with gold going up, they're going to take off. And I said, no, this is a different species. This is an industry where they're burning matches. They got to raise a lot of money. The financiers have the juniors by the you-know-whats. We're going to rebound. When we've seen the lows, but the big off to the races and them going straight back up and making up for all they lost, I don't think is going to happen at least to 2013. We had a rebound, and now the inevitable pullbacks come, and there are a lot of companies, who have to raise money. Their share prices are quite low. They got to dilute. And then the inevitable thing happens in the junior market once we really get past the middle of November. For all practical purposes, people start to shut down for the year. So I think it can, rally a little bit more, particularly if and when gold gets above 1,800. But I don't think anything of sustainability past, several days to a couple of weeks can occur until we get to next year. Because one of the things we talked about earlier is I think we're going to see, and have been seeing, and will continue to see, tax loss selling. I still see it in companies even that had great news this past week. Suddenly stock comes out of left field, and I think a lot of that's just people saying, look, I want to use this strength or at least liquidity to get out of this, and that's what I think is going to continue until, I think most of it will dry up by November, and then you got the real end of the year people that wait to the very last day.
With the year-end people or those that are flocking to do some tax loss selling, does this present a buying opportunity if there's increased selling pressure, driving stock prices down as you head into, the mid-December? Does that present any sort of buying opportunity with some junior resources?
I think you have to look at it, but I don't think they're going to get back to the lows that we saw in August. I think, we won't get that low again. I think there's enough reasons to be optimistic, and a lot of the it's just selling into no-bid markets. And there are bids now, but they're lower. But like I said, I don't think anybody's prepared to chase markets up or chase these stocks up. So I just think, at best, we may be either side of 5% or 10% where we are now. But any real sustained gain in the junior market won't come until next year.
Okay. Now, having been talking about the junior resource sector, any individual companies that you like now?
Let's see. Well, it's my stable, my clients, which most of them I own, and one way or another, it's disclosed where it is. And maybe I like to bring up something too about that. But I'll start with let's see. The iron ore thing is an interesting story. If you believe, as I do, prejudicial wise or otherwise, that there will be an eventual rebound. The need for steel is going to still be strong. Then the iron ore stocks, really have taken a beating. Some of them more unfairly than others, like Alderon, I think, can be looked at. And that's, then the further you go down the food chain to the more explorers like CapEx Ventures, and even further down the chain, something like Richmond Iron Ore, they're very attractive long term, but there's just not going to be a run into them anytime soon. So I'd rather go to the higher level, a company that's taken much of the risk out of its future. Yeah, people, are nervous now, but anybody with a brain will realize they'll be around, and they've de-risked most of their selves, like Alderon, that's just, under $2 is worthy. I think what you're going to see now is, and it'll tie into this tax loss selling and what we spoke about the junior market, is companies that are starved of major news and just, not likely to have it, because although they're doing real well and they're moving up the corporate ladder, they're at those stages where there's not something that's going to suddenly, like a drill hole or something, drive it up. I can think of companies like Donner, a uranium company like Crosshair, Excelsior, even Spanish Mountain Gold, which is just a phenomenal story, but it's in that dull stage where it's kind of moving from explorer and developer into eventually a producer. And so if you get weakness there, like you said, they become attractive. But, I like to use this time if I can. I never try to abuse the privilege you give me of speaking, but I'm going to do it here. And I'm speaking more to my readers, Al, than maybe your listeners, but I think it can help your listeners as well. I've always tried to say that the way I conduct myself in my business, I really consider myself among the most open and fair-minded people in the positions that they have in our business. I think in terms of disclosure and being candid, talking about losing and so forth. I had an experience, and I try to take in the emails we all get. I don't like to respond to them on an individual basis, because then it's not fair to everyone if I don't respond to each one. And then many times people take something I say, turn it around, post it somewhere, and before I know it, I'd have a bigger headache than if I didn't say anything to anybody. But having said all that, I'd just like to use an example. And boy, there might even have been a client or used you, so it may even cause a problem for you, Al, so you can cut this part out when we get
No way. I'm not cutting out anything, Peter. I don't cut anything out.
I'm going to use an example. And again, they won't like it, but after what transpired today, I don't want to say they deserve it, but it needs to be said. I worked for, in the past, a company called North American Nickel, and in the middle around September, I put out a comment. I was no longer going to work for them. I said that there was a difference of opinion between myself and the man in charge. There was nothing on the project side of things that impacted my decision, but I wouldn't discuss it any further. I noted I still hold my position. I even noted that I may even put it, and I did that day, put in a buy order if the market had gone lower. And I never bought the stock, but I had maintained holding it. So people call or email, what do you think, what do you think, what do you think? And like I just said earlier, an individual. Today the company put out some news, and I made a comment on my blog about it. I think it was a fair comment. I said that most people were interested, but the fact that this is a seasonal play, and if there's no big, great discovery noted in the drill results in the next few weeks, because it's seasonal play, people may sell it, even though they don't realize that's exactly how world-class plays get started, which would suggest that I think this is going to end up being a world-class play, and I know that I'm likely to sell my position and consider it again after the new year. Well, I heard from, someone related to the company that does work for them. In fact, they were the people that originally turned me on, and that, they're not happy, they're discord that you said this, just like they weren't happy when I didn't want to September promote or talk the way they wanted me to talk. And instead of that, I quit. And I gave up compensation and all, because I didn't want to do it their way. I wanted to do it my way, and my way and their way were two different ways. And why I take all the time to respond to this and all is it goes back to the picture that I've always tried to tell people about the junior resource market. It's an extremely tough game, and it's gotten tougher for all the reasons you and I have discussed, from changes in the way it works to financing to brokers not being involved in these things and so forth. And when you compound it with still, even in the year 2012, some people still running it like it was the old Vancouver Stock Exchange, It's a very, very tough game to do. And then to tie that on, I've been gotten into a position in one of the companies that I work for. I'm compensated. It's my largest holding, Oromon Expirations. I've been speaking about it, and then people go and post and talk about it, which they're entitled to at a bull board. But then so much is said there erroneously. It's sent to me. What do you say about it? So I go and see what is said. And then I have the choice, just like I said again, do I respond to people individually, and then, they take things out of context, go wrong, or do I make a response, as I just did in this other situation, on my blog, which I do? And I don't want to say that people shouldn't read these bull boards, because I understand the individuals out there with a very limited resource to find out what may be happening. Hey, look, they may not be able to trust IR departments. They may not be able to find what they view as objective newsletters. So they think talking among themselves, people like themselves, they'll be more objective. The problem with much of the bull boards is people have motives. They have motives for everything. We have motives why we get up, and we have motives why we go to sleep.
Right.
And many of the motives for bull boards are not in the best interest of the average people. And so, it's just a very, very, I guess, to sum up about the junior market, including my own companies, including myself, I bet my lungs and lost them more than once. I should not be breathing based how it is. It's a very, very tough and difficult game. Unfortunately, the very people that I work for at times don't want that said. And the end result is I end up working only for the companies that don't mind me speaking my mind, even though I'm compensated. So I just like to close with, to my readers that listen to this and yours, be careful, caveat emptor, definitely in the junior market. There's still great opportunity in it. It's the only place in town where pennies could be made into dollars, if not hundreds, if not thousands of dollars. But need to be careful. And sometimes, I think at times, if people would just, and I've said this all, treat it like they were going into a casino and be prepared to lose part or all their capital, both mentally and fiscally. If they are, then they won't have bad times. But too many people go into this with best case scenario and never have a worst case scenario plan, and that's where I think the big mistake is made. Okay. Sorry for ringing on, but
that's okay.
I guess it had to come out.
Yeah, you know what? I know we've been running a little late, but that's okay. And there are two other things that I want to say before I let you go. Okay. You had mentioned the word today. The date of today's recording is Wednesday, October 3rd. It's almost 6 o'clock Eastern. The markets have closed. But later this evening, we talked about, or you had talked about Romney and President Obama. The debates are going on tonight. Are you going to be watching them? And if not, what are your thoughts?
I'm not going to watch him. Look, I don't like Obama.
I think you've mentioned that once or twice,
yeah,
Peter.
We don't like him. I don't like what he stands for. There are people that want the world and the country to be his way, and if enough people vote him in, then that's what it will move towards. I will tell you this much. If you're a bull on gold, you want Obama to win over Romney. I mean, I think Obama just will add 20, 30% minimum to the move in gold coming if he wins. But I'm not thrilled about the guy that I have the choice from. I mean, I personally think Obama got in because people just couldn't stand the last guy that was there. Okay? So now it's a question of lesser of two evils. I mean, I don't see either one, or quite frankly, either party in a position to do what it takes, and that's because the whole system is broken. The whole thoughts of, I don't know Canadian politics, but the whole idea of American politics and founding fathers and what representation in Washington was supposed to be, and one of the ways to get through that is limit terms. You get 1 6-year term, then you don't have to promise everybody everything. You can go there and try to do what you want to do. The whole system is broken, and when systems get badly broken, inevitably the whole house has to crumble and has to start over, and eventually that's what's going to have to happen in America. And thank God for Canada for two things. One, it's not tied to the hip in the same manner that it once was, and it, 20-something years ago, was going down the same road, but made the right decision at right times, fixed its fiscal house from a federal standpoint in order, and will be able to sustain and live through, even though a close trading neighbor is going to have difficult times. Canada has its own series of problems. It has the same aging problems and debt problems we have, but not to the degree. But one of the things America would love to have that Canada doesn't have, Canada can take care of itself. It can feed itself. It can provide the energy it needs and the water it needs to drink, and the United States can't. So all hail north of the border.
And you know what, Peter? You're just leading into my second and final point for the evening. For the benefit of your American listeners that may not know this coming Monday is really my favorite holiday of the whole year. It is the Canadian Thanksgiving. And you and I, we can both complain and talk about things that are wrong, whether it's business or the world in general. But you know, at the end of the day, you and I, we have an awful lot to be thankful for.
We do. We really do. And just the ability that you and I could have this conversation and not be worried about somebody breaking down our doors and shooting us for saying it is one of the great liberties that we have in North America.
Okay, and I think we'll just end it on that note. Having said all that,
about the Cowboys or anything like that?
No. I think we'll just leave it. Happy Thanksgiving from one Canadian to my American friend.
Thank you, and a true blessing to all my Canadian friends and listeners I know that listen to your program. Just enjoy the day and be grateful for family and love and food on the table and shelter over your house.
Hear, hear. Peter, as always, thanks very much for your time, and I look forward to talking with you again next time.
Thank you, Al.
All right. This interview appears on my website, corporateinterviews.com. It can also be accessed on YouTube and iTunes. Just type in Grandich in those respective search engines to not only access this interview, but interviews that we've done in the past. If you have any questions for Peter, by all means, send me an email. My email address, very simply, al@corporateinterviews.com. We'll do our best to mention it on our next program. For Peter Grandich, I'm Al O'Grady. Thanks very much for joining us.